everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is Canada Pension Plan. I don't know how excited you are about Canada Pension Plan. The reality is that if you work in Canada or if you work for yourself and drawing out a salary, chances are you are contributing to this Canada Pension Plan. Willingly or not, you have to do it. And they are making some changes in 2024 onwards, and they're making us to contribute more because the government thinks that we are incapable of saving for ourselves. So therefore, they are making more changes to make sure that they take more money from us and help us save for our future. Now, before I go into all the nitty-gritty details on how this change would affect everybody, if you like our video, make sure that you give us a thumbs up and hit the subscribe button below so then you can stay on top of the latest tax tips. With that, let's get started. So for those of you who don't know what CPP is, the Canada Pension Plan, it's essentially a federal retirement saving plan that the government forces us to save. Essentially, they take some money from our paycheck. Our employer is supposed to deduct it off our own paycheck and deduct that money and send it to the government. So even though you may be earning $100,000 per se, but you don't really actually receive the $100,000. And your employer would be deducting the CPP, would be deducting from your paycheck the EI contribution, employment insurance contribution, together with your income tax withholding, and deduct it before they pay you the net amount. On a monthly basis, you are paid way less than what you are supposed to be paid for. And all these net amount, CPP, EI, also your source deduction, the tax withholding, are all being sent together to the government on a monthly basis on behalf of you. So when we talk about contribution to Canada Pension Plan, it's automatically done for you. You don't even feel that. You may not even notice the difference in your paycheck when you make the contribution. But this is the Canadian government way to force you to save. They think that we are incapable of saving for ourselves, and therefore they decided to force this saving plan onto every single Canadian out there and draw the money from your bank account or before it hits your bank account and send it off so that they can manage the money for them on behalf of us. They think that they would be able to manage the money better than us managing ourselves. That is such a funny joke. Anyway, besides the point, the reason that they're making this particular change right now is because they think that there's inflation. And so they need to increase the rate, increase the amount of CPP, essentially increase the amount of the retirement saving that they're doing for us. So they want to draw more money from us. And so then they can put more aside in the future so then we can have more retirement saving when we reach the age of 65. This is the background of the full story. Now, how do you calculate CPP to begin with? Well, CPP actually has a maximum amount. The maximum you can contribute to CPP in 2023 is $3,754. The calculation works like this. You take your salary, whatever the amount is, if it is over maximum pensionable earning, there is a maximum cap on it. In 2023, the maximum pensionable earning is $66,600. And so they take the $66,600 if you earn more than $66,600. You only need to use the maximum pensionable earning to do the calculation. You take the maximum pensionable earning minus the basic exemption, which is $3,500. And then the delta of that, you use that to multiply by the rate. And in 2023, that rate is 5.95%. So for someone who's making $66,600 or more, the CPP contribution amount would be calculated as $3,754. Now, for someone who makes only $60,000, which is below the maximum pensionable earning, the actual amount that you will be contributing to your CPP in 2023 is $3,362. So you take your $60,000 minus $3,500, the delta of that multiplied by 5.95%, that would be how you calculate your CPP contribution from your paycheck. Now, In 2024, what becomes different is that now they come up with this, the government come up with this tier system. What it really means is that when you reach the pensionable earning, maximum pensionable earning, the maximum pensionable earning for 2024, by the way, has increased to $68,500. So you still come up with the same calculation. If you are earning $68,500 and below, you take your salary minus the $3,500 of exemption. The delta of that, you take it and multiply it by 5.95%, which resulted to, if you earn $68,500, this will result in $3,868 of CPP contribution. The biggest change is that there is now a second layer, second tier. And this tier basically says that if you earn anything above $68,500 up to $73,200, the delta between the two, which is $4,700, is going to subject to a 4% CPP rate, additional rate. So you know tier 1, anything below $68,500 minus your exemption, you use that to multiply by your 5.95%, that comes up, that gives you the CPP payable. Now tier 2, you also need to take your salary. If your salary is over the second tier ceiling, which is $73,200, then the maximum total contribution amount is $4,055.50. Now it gets complicated, I understand it. So let's use an example. Now, if you earn $100,000 salary in 2023, your maximum CPP contribution would be $3,754. But if the same $100,000 salary in 2024, you now have the first calculation of the base calculation. You take the $68,500, which is your pensionable earning, multiply that by 5.95%, take the delta between your pensionable earning and the exemption, multiply that by 5.95%. That resulted in $3,868 of tier 1 CPP payable. But because $100,000 also exceed the second ceiling to second tier ceiling, that additional earning, it would also result in an additional $188 of tier 2 CPP payable. With that, the combined total is $4,056. So essentially from year 1 to year 2, from 2023 to 2024, with the same $100,000 salary, this taxpayer would have to pay an additional $302 of CPP contribution, unfortunately. Now, if you are earning something like $60,000 salary, on the other hand, the CPP payable calculation stays the same because the $60,000 is below the first tier ceiling of $68,500. So the calculation, you still take the $60,000 minus the $3,500 basic exemption, and then take the delta and multiply that by 5.95%. So the same amount would come up as $3,362. 2023 and 2024, if you earn $60,000 salary, no change at all. So what does that really mean to all of us? Well, it means that we have less money in our pocket to spend on a daily basis because we're putting more away for our future saving, for our retirement. Now, but if you're self-employed, what's going to happen? Well, if you're self-employed, if you don't already know, you are contributing to CPP twice. As an employee, you contribute to your CPP. Your employer deducts the CPP off your paycheck, and send it off to the government on behalf of you. But on top of your portion of the CPP, your employer also make a contribution matching the same amount of CPP that you pay. So your employer doesn't really just pay you the salary that they say they pay you, but they also need to match your CPP contribution and EI contribution and lump it all together and send it to the government all together. Now, if you're working for yourself, if you pay you're working as a sole proprietorship, own your own business, you have to pay CPP yourself. And in the eyes of CPP, you are your own employer. And what it really means is that not only do you have to pay the employee contribution portion of the CPP, you also need to pay the employer contribution portion of the CPP. So for someone who net $100,000 of business income, in 2023, this person would need to pay 2 times the maximum of the CPP contribution, which is $7,509. For this same person who's netting $100,000 on their personal tax return from their business income, this person would now have to pay $8,112. This is an increase of $604. So there is an additional cost of owning your business if you own your business in your personal name. Now, but hey, Cherry, 1 second, I own my business in my corporation, so how does that work? Well, the reality is that when you own the business in your own corporation, you have the flexibility of paying yourself in the form of salary or in the form of dividend. If you pay yourself in the form of a salary, your corporation would have to contribute to your CPP, and again, when they pay you, they also need to deduct the CPP portion from your paycheck and send it to the CRA on behalf of you. So when you pay yourself a salary, CPP is one big determining factor because sometimes the cost of CPP would essentially offset against some of the tax savings that you would have. Now, so if you are paying yourself a salary from your corporation, like I mentioned under the sole proprietorship example, now you are contributing twice. Your corporation contribute once and you contribute another time to your CPP. So in 2024, again, doubling of the increase. If you pay yourself a $100,000 salary, you would have to pay the government $8,112, an increase of $604 of contribution. Now, this really sucks, but if you're your own boss, you have the flexibility to pay yourself a dividend instead of a salary. So in front of you is an example that if you pay yourself a salary of $100,000, instead of comparing that with paying yourself a dividend. If you own your business in the corporation and that business earns you $100,000, the corporation would have to pay $12,200 of tax in Ontario, and that means the net money available after paying the corporation tax for dividend distribution would be $87,800. And the personal tax on $87,800, assuming that you have no other business income or any other income, would have been $11,074. So net amounts that could be retained by the individual, by you, would be $76,726. Now, on the flip side of it, when you issue yourself a salary, the business also have to match the CPP contribution. So instead of having $100,000 available to distribute to you, the business would only have $96,246 to give it to you as a dividend because they also have to match your CPP. So as a result of receiving $96,246 of salary, you would need to pay a personal tax amount of $17,700. Now, and then plus, you also don't get to receive the CPP because the employee also have its own portion of CPP to be reported. So you also have to contribute to your your CPP an additional $3,754. So combining the impact of employer and employee portion of CPP, the total that you're going to get is $74,791. Now, if you compare the two options between paying yourself a dividend versus paying yourself a salary, you can see that by paying yourself a salary, you could have an own saving of $1,935 just by swapping that. Now, you may say, hey, don't you think that paying into CPP is not a cost? I actually watched a couple of financial planners' CPP video, and they're trying to explain to the audience that CPP is kind of like a saving account. I guess there are two ways to look at your CPP contribution. One way to look at it is that your CPP is a saving account. You're making contribution to it. The more contribution that you make to your CPP, the more money you are going to get back from the government when you retire at the age of 65. Now, so that's one way to look at your CPP, kind of like a contribution account for your retirement. You're putting some money away. You don't have a choice anyway. You're putting the money away. You're going to get some money back. Now, the other side to look at the CPP account is that it's totally a cost of operating the business. And if you can avoid it, you will try to avoid it. Some people say that contribution to your CPP is not a taxable amount, but the reality is, do you trust our government to control your money? And especially we're talking about over $7,000 on an annual basis for the people who have a choice. For example, for a self-employed individual who earns more than the maximum pensionable earning, they need to contribute $8,000, over $8,000 into their CPP plan on an annual basis. Can you save that $8,000 and invest it somewhere and earn a better return? And you would have a better amount, you would have a better return and a higher amount coming back to you when you at the age of retirement. So those are the questions that you need to ask yourself. If you are on the belief that, hey, my CPP is a CPP contribution saving account, I'll always be on the side that I'm paying CPP because it's saving for my future self, I trust my government, I will get my money back, then by all means, pay yourself a salary. You actually pay less tax by paying yourself salary. If you are on the boat that CPP is a cost of operating the business, you want to eliminate and minimize the amounts of costs that you need to pay to the government, and you don't want the government to have any advantage, then maybe paying yourself a dividend would be something that's more preferable. At the end of the day, if you pay yourself $100,000 in the form of dividend versus in the form of salary, if you choose to pay yourself a dividend, this could potentially save you $1,935. You get to keep that in your pocket and invest for yourself. So those are my little tips and update about CPP for 2024. If you find our video useful, make sure you give us a thumbs up and subscribe to the button below. Until next time, happy Canadian real estate investing.